Before we begin, we must provide a disclaimer that the following information provided is not investment advice. Our methods, teachings, and content are for educational purposes only. All materials, lessons are protected assets of Market Making Strategies LLC. With that being said, afternoon, everybody, and this is going to be our first options lesson. This is going to be a very basic understanding. I am not here today or to teach you how to do options. We are teaching and showing you how you can involve the prints into the formula when you are creating your options plays. And more importantly, how do we create our plays off options? That's what we need to learn here today. So, sorry, I'm still seeing people coming in the room. Apologies. But this is going to be the last person. Okay, so we can't let no one in. Okay, so what is it that we need to know that's different in our trading of options as to regular? So typically when you're trading options, or if you're going long-term in swings, you're basing it off what you know, basing it off what you've read, the news that's come out, some research that you've done, and possibly just because you like a company. We do ours structurally completely different. We base it off the prints, which means we base it off the big buying and the big selling that we see on the tape. And from there, that's how we create a strategy for either options, which is the particular method that we use when we're looking at short-term, mid-term, and long-term for those prints, and for the way that we saw the acquiring done. And it could be vice versa. So if you're seeing a huge short position being built, then you'd be looking to take puts. In our option strategy, and when I say our, just to make it clear and content, this is my option strategy that I did based upon being a day trader first. So I started as a day trader. It's been just over 10 years, learning how to read the tape, understand how it works and so forth. And then as I started to learn options, I learned how I could integrate both of them together in order to give me a method that would work with the best variable there is, and that's the prints. Now, why is the prints so important? Well, the prints are very important, quite clearly, because when you have a hedge fund or you have a bank or you have a institution that places a lot of money, millions of dollars of buying at certain levels, that is basically telling you in short and simple terms that they have done the type of research and analysis on that stock that we just cannot do. They have so many resources and teams of smart people and systems and protocols and have access to information that we're never going to have. So if you're looking for validation of a stock, there's nothing greater than someone coming in and buying millions of shares, especially when you know that they can do research 100 times better than you're going to do and have access to information that you don't. And when it comes to options, why that becomes particularly good is because it allows us to then know our timing. So for instance, if you really liked a stock called XYZ, you did a bit of basic research, you heard them in the news, your friend told you about them, or whatever the case may be, and you said, I'm going to take options, it seems to be moving, and then you take options a month out or 2 weeks out, or that's the typical that people usually trade options daily, weekly, or monthly, giving themselves a very short time frame for that to meet its targets. And they don't even have a target because targets are based upon knowing where prints want to take them. So if you were to take a position without prints, there's a great chance it doesn't move. It doesn't need to move. Stocks move because market makers move them. You cannot move a stock without somebody buying enough or selling enough for that to move. So that's exactly how market makers will move positions, is that they need to buy shares. So if you're doing it without understanding prints, you're hoping the movement will come. When we do it with prints, we now know that it's going to move because they're buying. That means that these market makers are the ones that move the market. They're the ones that move the stock. They're going to move it towards their price target. Now, what we will see as we go through this presentation is how do we decipher the timing and how does that look like and how does that work? So let's get going on this now. So what are options? Options are financial contracts that give the buyer the right to buy or sell an asset at a specific price by a specific date. Options are a type of derivative and they can be traded on a public exchange. So how do the options work? The buyer pays a premium to the seller for the option. The buyer has the right. So what does it mean by the buyer pays a premium to the seller for the option? Basically, what happens in an options contract is, in layman's terms, you're going to someone. Obviously, this is all happening through your brokerage, so you don't know who is holding the shares. But if we wanted to use an analogy to make it nice and simple, which I'm going to show you on the next page, you're basically saying to someone, I would like to control your shares for a set amount of time. That gives me the right to either sell your shares or I can even purchase your shares at a specified time within the time that I have agreed upon the option with you. So if you have a 1 month contract, a 4 month, or a 1 year, you are in full control of that person's shares for that time. The buyer has the right to buy or sell the asset at the strike price. That strike price, quite simply, would be the agreed upon price point where up to that strike price. So for instance, if the strike price was 20, that means that up to 20, the person who owns the shares at the current moment that you're now controlling, all the profits are theirs up to that strike price. Anything that goes above the strike price would be the buyer's financial gain. The seller has the obligation to buy or sell the asset if the buyer exercises their right. Basically, just leading on from number 2, saying that the same way the buyer has the right to buy or sell the asset of the strike price, the seller also has the obligation to buy or sell the asset if the buyer exercises their right. Number 4, the option expires on a specific date and its value is settled among investors. So the type of options that we do is very basic. There is many different methods of options. I know I've heard of plenty of them, and I know none of them. Why do I know none of them? Because all of these different option strategies are based upon protecting your initial position, are based upon all these dynamics because they do not have access to prints. When you have access to prints, we already know. So for instance, if I really did like, let's say, Apple, but every time I look, Apple we know trades quite often, but we're going to use it as an example anyway. Let's say Apple's trading sideways for many weeks and months. It's holding its price levels. It's not had any significant news. Earnings aren't anywhere closer, so that's not going to help change the price point. And you decide, you know what, I really like Apple. I think they've got a new products coming out soon, and I really believe that it's going to go up. Then you get into a position and you realize it's still going sideways for months. Now, in our option strategy, basing on prints, if I really like Apple, that's one thing, but I do not take an options position in Apple until I see big buying coming in, the type of buying that validates my theory. That's the beauty of prints. One, it's the strongest variable there is in the market. And why is that? Because it's the presence now of market makers, the ones who can move the stock to a price point. So the beauty about our options and the reason we only need to buy calls or buy puts is for that specific reason, because now all we need to do is buy, knowing that the movement is going to go towards a price target, we can set our options and create a contract based upon the price. So if you know we have 100, let's say the buying on Apple comes in at 100, just to make life simple. And the buying says that we have a price target of 110. And the way that we realize this, and we say, okay, it should reach 110 within maybe 2 months or less. So we create a strike price and we see these prices and we're like, okay, we're going to go in. I see 110, 2 months out. That's going to be my strike price. Well, we've already know that it's got to get to 110 on the buying at 100. We've already created and understood the play that the MM has already done. The MM is going to have to take that stock to their price point, to the target for the buying that they've done. That makes our life so much more simple. Once we got the prints and we know exactly what the price target is, the next thing we need to determine to our best ability is when will that happen. I'm going to quickly have to stop this because I'm seeing a lot of people trying to get in the room, but unfortunately, I'm not able to access my mouse for some reason. Give me 1 second, please. Okay, apologies for that. Miller, could you just put a note in the room that the room is now closed off? Okay, so how do we start learning options? Like I said, we're not here to really teach options. We are a research-based company. So what we will be doing, this is the first basic class. I will be showing you in these slides the basic premises of options, but learning how to execute options, you're going to have to read books. There's Options Playbook is a very simple one. There's a few others that are good out there. Read some books so you understand how options work. Set up your brokerage account. Remember to have full options approval when you do. Now learn how to place options and sell options. So basically, how do you execute on options? You're going to find that you probably have many different YouTube videos or instructional videos that come from a brokerage that will teach you how to do that. So that's how you're going to learn that. So here's a basic understanding on options. This will make life a lot easier for you. The one option contract is equivalent to 100 shares. So when you see an option, one option or an option contract is equivalent to 100 shares. So let's just put this in the most basic understanding there is. Dave owns 100 shares of Apple at $10. Now we know clearly Apple's not $10, but we're just making this simple. Doug wants to control Dave's 100 shares by purchasing it as one option contract for a 4-month period at a strike price of 15. So basically, I go up to Dave and I say, Dave, I see you've got 100 shares of Apple. I know you bought it at, let's say, $2. You're well into profits. It's far, far away from when you purchased it. I think Apple could go to $20. And I think it's going to happen in less than 4 months. And Dave goes to me, yeah, I don't see that happening. Apple's been trading between 8 and 10 now for 6 months. What makes you so sure all of a sudden it's now going to go trade all the way up to $20? I haven't seen it in 6 months and I don't think it's going to happen. So, okay, let's have an agreement. So I offered Dave, I say, okay, let me control it for up to 4 months. I think that would be enough time where I believe we'll hit our price target. And I'm going to pay you $2.50 for a contract. Now, when you say $2.50 for a contract, that means $2.50 per share. So you got to times it by 100 shares. So I give $250 to Dave. That is the cost of our contract. He now allows me to control those shares for 4 months. He has no right at any point to withdraw on his agreement. That is a contract that he no longer can do anything about. It is in my full control for up to 4 months. Even if Apple went all the way down to $3, he cannot sell it. So imagine you have this huge buffer of space between where you purchased it and where the price is currently. And then you put it into an option contract. And during that period, the price of that stock goes all the way down. The person who owns those shares cannot sell. It is in full control of the person holding the contract. So now, 2 months into the agreement, Apple beats earnings and moves to 20 in price. Now, how does that happen? When I started the contract with Dave, yes, it's true. Apple, I could see on the daily, was going sideways for 6 months. But then, as we were day trading, lots of buying started coming into Apple. Let's say it was a week before or 2 weeks before their earnings. And it was huge buying at levels, buying short term, huge accumulation of a position. Well, Dave can't see that. Dave's not a tape reader. Dave has no access to prints or understands how to even navigate through prints. So he believes what the chart tells him. He believes what he's seen for 6 months. And what he's seen for 6 months is that his stock has gone sideways between $8 and $10. He has no reason to believe there's any way that a stock like Apple, even for the interim, for a short period of time, has any need to go as far as $20. That's 100% return. But the type of buying that we've seen at 10 says there's a first target of 15, but an overall target of 20 because of the amount of buying that we've seen. Now, let's say we get the agreement and then the earnings come up and it validates what we say. And next thing we know, not only is it moved to 15 before earnings, but with earnings, we're now at 20. So we've hit our price target. So now I sell the contract 2 months in. So Apple's at $20. I sell it at $20. Our strike price was 15. So that means there was a net gross margin of $5. What does a gross margin mean? The $20 is what we sold at. Up to $15 is Dave's. So he gets all the profits up to $15. And we also have to then minus from the $5 what we paid to Dave. Remember, we paid Dave up front $2.50 as the cost. So that comes out of the gross margin of $5, which now comes to $2.50 net, or we know it's 100 shares, so $250 in profit. So that basically means in less than 2 months, we made 100% return on our investment. And remember another thing. We only had to pay $250 in order to make $250. Your investment is so much lower when you do options than if you went and outright purchased those shares. If you wanted to buy 100 shares of Apple at the time at $10, you've got to pay $1,000. We are paying 25% of that. If you paid $1,000 and it went to 20, yes, you'll make $1,000, but you have to put up 1,000. In the same respect, if it was a high percentage position, you could have bought 4 contracts for the same price, and you still could have had the same amount of profit. So when you're doing options, your cost is far less, which means your risk is far less. And also, that's all you can lose is $250. If you bought Apple at $10, and I'm just putting this as just an example, and you risked and you put $1,000 on for 100 shares, and now Apple had really bad news and you had no idea what's going on and you weren't paying attention to prints, and it went down to, let's say, $5. You've lost $500. So the risk to reward is different. Now, we're going to go into the next part. Sorry, let's have a look. So what is the difference between stock trading and options trading? Well, the ownership of the asset. When you're stock trading, you own those shares. So even if it didn't hit 20 in 4 months and it hit it in 6 months, although it took you longer to hit your target, you don't have the problem of time decay. So you can sit there and own it. In the ownership of an asset in option trading, you don't own the underlying asset, but have the right to buy or sell it at predetermined price. So you don't own the shares, but you control them, and you only control them up to a certain time frame and up to a certain strike price. The profit potential in stock trading, profit is directly linked to the stock's price movement. Your returns when you own shares is going to be a lot less than when you take options. And I'll give you a quick example. If you bought 1,000 shares of Apple at $100, that would cost you $100,000. Now, let's say that we saw the buying for 100, sorry, the buying at 100 to take it to 110. Let's say you did that. That means you made $10,000, but only a 10% return on your investment because you invested $100,000 and you only made $10 gains. So your gain was only 10%. But if you took this, if you were to buy options, and let's say you bought 10 times as many options, and those options cost you for 1,000 shares, you could control 10 contracts for, let's say, $2,500. So you're still controlling the same amount of shares, but only for $2,500, as opposed to paying outright for those shares, which would cost you $100,000. Most people don't have $100,000 to buy Apple and hold it. But a lot of people, if you're timing your options correctly and you're doing our method, so your time decay doesn't always work against you because our timing is based upon the arrival or the insertion of money, of smart money, you can buy the same 1,000 shares in 10 contracts for only $2,500 and control it up to 4 or 5 months. And your returns would be far better, especially if it goes far past your strike. Because remember, if as soon as it passes your strike, so let's just say in this instance, our strike price was 105. I'm just making it up. And now it goes to 100 and you pay 250, so everything applies the same. Let's say it goes to 120. The earnings were just ridiculous and it just flies. Well, everything above technically 105, you're making a dollar for dollar. So if it goes to 120, that's 15,000 profit minus the 2,500 that you have paid as a cost to control those 1,000 shares in the form of 10 contracts. You have made 12,500 profit on a $2,500 investment. That's 5xing your investment. If you owned 1,000 shares, but you had to pay $100,000 for it, so you bought the stock outright and it went to 120 and you decided to sell, yes, you made $20,000, but your return on investment was only 20%. So your return on investment's a lot larger with options, and your risk is far, 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 far less. So your risk exposure, we're going right into it, is limited to the investment amount in the stock. And for options trading, risk can be limited to the cost of the option premium for an option buyer, but losses can be unlimited for an option seller. That means that the risk is in your favor at all times, never in the favor of the person who owns the underlying asset. Because at the end of the day, your risk, if we just continue on with Apple at 100 with 1,000 contracts, your risk is always going to be $2,500 as an option trader. But like it says, let's say the person who owns Apple, whose shares you are controlling at $100, 2 months in or 3 months in, it goes down to $75. They are now negative $25,000 in their value of their underlying, whereas you come out of that and take that as a loss, you only lose $2,500. Leverage. So limited leverage generally tied to margin accounts, which basically means that you're paying for it with your money, or if you have the ability to use your margins, then you can do that. On the options trading side, offers significant leverage, allowing you to take up a larger position with a small amount of capital, as we were saying. You can use less money and control more shares with contracts. Time sensitivity. So now this is obviously the main one. Profits and losses are primarily influenced by the stock's movement. So you could hold as long as you want when you own the underlying, even if it's below your price point that you purchased at. If you still believe you're going to come down, but in the end you're still going to go up, you have the ability to do that because you own the stock. Time is on your side at all times, unless the company goes bankrupt. But if you're in the right stock, the chances of that happening are very, very limited. In options trading, time plays a crucial role. because it has expiration dates and their values impacted by the time remaining until expiration. So time decay is definitely the big risk factor when you're doing options, because the second that you place an option is the second that your clock starts ticking. But when we're doing it, like I repeat again, using prints, that gives us when the time is right to enter options. I could look at, if I right now told you all that I absolutely love, let's make up a stock. But okay, let's say Palantir. Palantir, we watched Palantir build heavy for a long time, but it built so heavy day in, day out, weekly, that it was never going to move for a long time. So when it builds to that extent, if you took options just based off simple buying, you would have been probably lost because of time decay. But if you bought that underlying at $5 or $10 and just buying straight out, you could have waited a couple of years. But here's the difference. When the stock starts moving and we see the buying is over, we already know that its price targets have increased significantly due to the amount of interest and the amount of positions being taken long term, that we know that the consensus is not that Palantir is going to go to a valuation of $15 or $20, but they're looking at a future valuation of moving towards 50. That's the type of buying that we saw. So that's the difference between stock trading and options trading. So what is our strategy in options? So replacing a trade follows prints always. Like I always say, there's nothing wrong in doing your research, listening to news, listening to friends of yours who are well informed about what their stocks are and giving their reasons. But you do not have to, if you're looking to do an option strategy play, then you wait and we follow until we see the prints are coming in. Now, I know many of you might not be day traders. You might not have access to platform where you can see all the prints currently, but you're part of the Discord group. And feel free always, this is just a side note, if you want to go into the short term, long term, or even in the day trading channel and ask the group if someone could pay attention, if they have time, to certain prints, I'm sure there'll be people who are willing to do so if they are there at the moment. But the reality is, everybody's also trading for themselves. They're all learning, they're all building their own understandings and their own strategies. So if it was me and you guys get to that stage, call your brokerage and figure out what's the best way that you can get access to at least see prints in the stocks that you like. All you need to do is have time in sales. It's basically the receipt or the prints or the printing every time buying and selling occurs. So that way you can monitor your own stocks and monitor it for when prints start coming in. So when buying or selling starts coming in, which will show that the movement is getting near or not. Meet price targets for the prints being followed. So the same way when we do day trading and we establish that there's buying intraday or the same day to go up $2 or $3 or $5 or even $1. The same way we want to formulate our option strategies the same way. So we look at all this buying, we create an understanding and say, how far of a target can this buying take us? What is the conservative target? And what is a secondary target? If long-term prints, which I will be showing you some basic examples of, you want to plan your options at least 8 months out. For me, I have no problem going a year or a year and 2 months out if I believe there's that much of a runway, meaning it has the potential to hit far more price targets than just the one that I've seen. Hence Palantir, IONQ, there's a few others. That way you take advantage of the complete move. And of course, you still strategize your near-term price targets, your midterm, and where you think it could potentially get to. And you can manage your contracts accordingly. You don't have to keep the whole position. You can start taking off, take profits off the table. Midterm prints. These are 4 to 6 months out. These are typically where I would go 6 months or 4 months out in my options. As I was saying in the room today, if SMCI, unfortunately, I didn't have internet to do it, But if SMCI comes all the way back down from the huge amount of building we've seen between 40 and 45 or 46, if that now pulls back to 40 and under because of the amount of build and the amount of buying above 40, that's where I'll be looking to add to my long-term options, but 6 months out. Why 6 months out? Why not a week, 2 weeks? We know it's moving because it is monstrous buying. That type of huge buying is not done to go up $1 or $2 or even 50. That's the type of buying that could easily hit 75. But that might take 3, 4, 5, 6 months. And that doesn't necessarily mean that even if I had a target that high, that I'm going to wait for that much. Because that we know that is still a long way away. But let me tell you, if you had a strike price 6 months out of, let's just say, $60, and it hit $60 a month or two in, the premium alone on your contract can easily go up 2, 3, 400%. That's still a great return before it even hits the strike. And why is that? Because if I'm paying $2.50 6 months out for a strike number that is $20 away from the current price, so for instance, if I found that I could pay $2.50 a contract for SMCI 6 months from now at a strike price of 60, then that same cost will go up significantly if a month from now or 2 months from now it goes closer to 60. Then that means that you are right there by your strike. You are there by the dollar for dollar increment. So the cost of that option is going to be far, far higher because anybody who likes in the money or close to the money, which is a lot of option traders, will pay a huge premium because they know they will pay a huge premium, but they're right there that they can now get a dollar for dollar value also. So many times when any of my positions have a huge run, have a huge movement, whether that's a leg up or on news, whatever it may be, and I pay $2.50 for a contract, and now suddenly it's worth $7, $8, $9, $10, that is an absolutely ridiculously great return. I might take 50% off. I have a golden rule most of the time, is that when I get to 300%, no matter what, I take 50% off. That allows me to make a huge return on my initial position. And at that point, I'm also playing with the casino's money. I'm not playing with my own money no more. That makes it even better. Remember, the goal is never to take your whole position to any strike point because you just don't know what's going to happen the further it gets away from your entry. So taking profits is a good thing. You can always allow 20 or 15% or even 10% to run towards the potential of your targets. Because when we have time decay, we have to be very mindful. And especially if you're up a few 100%, even 300% on a position, that is a absolutely ridiculously great return when you recognize that most people on a yearly would love to get 8, 10% return on their money. So imagine in 2 months, you're up 200% or 300%. That is absolutely great. So you've got to be, when you're trading, no matter what, even in options, you do not want to be greedy. Always have a smart system to succeed. You want consistency. You want consistency. So to have consistency, you got to have a protocol where you have rules. So like I said, if you want to know some of my rules, I personally would never take options less than 4 months out. Once I am testing it currently about taking options 2 months out when I see short-term prints, and I've been doing that for the last 2 months, and I will definitely relay to you. I can tell you right now I'm 5 for 5, meaning in they've met their targets or beat their targets, but I want to do at least 10 of these to give a better understanding. But for the most part, I always go a minimum of 4 months out once I see the accumulation of buying For instance, I am very interested in NBIC currently because of the buying I saw yesterday and the continuation of buying I see today. But more importantly, they're buying at higher price points, which to me always means when they're doing exceptional buying, which means buying on the way up, they see the valuation increasing of the stock at the same time. The sweet spot in price for me is never paying more than $2.50 for a contract. And I am always typically out the money. When you're out the money, that's when you get the huge rewards. Most people will not do out the money quite simply because they do not know timing. They do not know prints. They cannot plan price targets. We can because we add prints to it. So what are the short-term prints? How do we know if the build is shorter term? Well, when the acquiring or position is small. So if you look at OKLO, and this was between about late October, starting mid-October, early November. We remember at 10, when all this volume started coming in, there was beautiful buying at 10, beautiful buying at 10:50, 11. And it was huge volume. So when you've got really good buying in huge, consistent volume at levels, that's going to be shorter term prints. That means it's going to move towards their targets in a shorter time frame. So when they are moving to targets within the day with range still available, what do I mean by range still available? You can see the buying and you can see it moving away from the buying, but the amount of buying you see, you can see there's still a higher price target for it to reach. There's no intraday consolidations. You don't, when you start seeing that there's buying going on for days, if it takes days for buying, it's not going to take days to move to their target. That's just what you have to put into your head as a formula. If they do their buying in a couple of days, it could take a couple of weeks or less for them to move to their target, or a couple of days to take to targets. If they're building for over a week, it's not going to take days. It's going to take weeks or months possibly to get to their target because the amount of accumulation they're doing. There are no need to move there because they want a monstrous position. And not only will that signify that it's going to a certain target, but those positions are usually so large, there's going to be further targets on. So when we get to our first target, we have to reestablish if there's more buying for a further continuation. So as we can see with OKLO, which is interesting, this was a shorter term print. This is the one that yes, I do 4 months, but I took this 2 months out. And as you can see, it hit more than easily, got to their targets. Then we have midterm prints. If you guys remember DJT when we started the room, and I kept saying there's nothing but buying in DJT. There is so much volume coming into DJT, and we know what was a huge influence of this particular stock is it's Donald J. Trump stock. So we had in September the elections. I mean, we're going through elections. And we know one thing, that if there's a huge chance that he could win it, obviously his stock is going to move up. There's going to be a lot more interest in his company, especially with him being president. So we saw all that, and we know that the chances of this making a big move before the election results are announced would make complete sense, because that still hasn't given us a verdict. So it will keep positive sentiment about it. And that became a very, very strong trade. Those are midterm prints. Those are taking account for a particular moment or particular thing going on currently. And that's what we saw here. So how do we know if the prints or building are midterm? Building at levels, acquiring curves at more than one interval. So basically meaning, let's say it went to 30 and it hit 33, 4, 5 times. That's building a significant position, because every time that it goes back and it hits that same level and buys, we know it pulls back to build under also. It is accumulating massive shares. That is not going to move in the next few days. If they're taking days to build, it's going to take longer than days for them to move towards their target. So the risk So the position not only shows a near-term target, but a secondary opportunity, which means the next target because the buying was too big. The risk placed by the MM is too great for small gains. They didn't go out there and buy that many shares and put so many millions on the line simply for a day or two to take it up $3, $4. When they put a lot on the line, they expect a lot to come back to them. So you'll see that they're acquiring over a few days within a consolidation to build that big position. The volume is consistently high, but as we can see in midterm, it gets higher. They're moving it towards a target. They want it to happen. Movement from a buy occurs quicker. Now look at how interesting this is. OKLO had the short term and, as we see now, a midterm building. If you remember and you look at how our daily charts look when we're day trading, look at the volume. Massive volume, just like the first money time phase of a day trade, happens in a shorter period of time. The buying is nice, but not as nice as the volume. So it can move off on the buying. It doesn't need to take as much time to build, doesn't need to pull back as much because it's using the volume to acquire as it moves. But then it went into a long consolidation, which we're currently sitting in. And in that consolidation, I can tell you there's been really nice buying, the type of buying that will take it to minimum 30. But it's been sitting in this consolidation now for nearly 2 months. If you took contracts 2 months out with time decay, you would have been out of your position. But if you see that the volume had also dipped off, which means build phase, as we see in day trading, then we know that we have to allow for the build phase to first complete itself before they move it up towards the price target. And if you're looking at that right now, at that chart, look at that volume. It's waning all the way down on daily. If you look at the consolidation, it's forming a flag. And if that volume comes back in, it's most likely going to move off 22 or 24 and move towards 26 and then 30 relatively quickly, the same way it moved from 10 to 22. And if you looked at it even further in a calculated move, if you took 10 to 22, that's $12. Then you can see, interestingly enough, typically when we're doing day trading, we'll see that 22 would cap the high of where the consolidation is going to come, but this didn't do that. This is consolidating between 18 all the way up to 28. So even if you looked at the basic $12 move of 20, that'd be $32. But we've seen that they are consolidating this in a $10 range. So if you're consolidating in a $10 range, are you really looking to make $4 above 28? I'd assume no. I'd assume with the right information and the right volume, this could easily see 35. But we know 30 is a psychological level. We cannot plan past a very important level. Hence, I've said that this has the buying for 30. But I can tell you that would 100% be my initial area of interest would be 30 because it's a psych. But at the back of my mind, if it moves past that with very minimal build, that would never be a shock to me because I plan that this could hit 35. So it's interesting that you see a short-term and mid-term strategy in options within the same stock. Longer-term prints. How do we know if the prints are longer-term? This is when the acquiring happens for days, weeks, months, just like Palantir, just like Snap did for a long time. Sophie did for a long time. Soon did for a long time. And that's not, don't think that's for weeks and months that somebody's going in and buying all the shares. There's just not, the outstanding shares of any stock are not that high that you can do that. But there's certainly positional changes and there's certainly a lot of large institutional money sitting and waiting for the right moment. So the prints at the controlling levels are too big for short term or midterm. A huge position taken one time. So sometimes what you're going to see is someone comes into a stock out of nowhere and just buys up a bunch of shares. And let's say a stock's been trading, nothing ever happens. It's not even a day trade. There's no real movement. There's not real participation from retail. And all of a sudden it goes towards a number like 15 and somebody buys 250,000 shares. And then nothing else ever happens. And there's no other volume. There's no other trading. That's not a stock you want to go look at and say, oh, I saw buying at 15 or I see him buying and oh, this has to go to 20. No, the reality is there's nobody else who has interest. Only one person has interest. Now, do they have the golden egg? Who knows? But it's not going to validate me to take any type of position if no one else is interested. You might want to say to yourself, well, this person just bought a lot of shares. They must have some clue, but I'm not going to go short term, midterm. This is something I'll wait and see and buy options maybe a year out. That's a whole different understanding that you can do within that situation. But I'll be completely honest with you. I have tested that many a times, and very rarely does it all come into fruition the way you want it. So when you see a one-time position taken, I would say be very careful because I don't like to base my analysis just on one person randomly buying a bunch of shares because that typically is not institutional either, or those who can move a stock, which is the key, right? For our options, knowing that we got time decay and knowing that we're following prints, we want the type of prints that are trading. We want to see that the prints that are trading have a lot of positive sentiment, have a lot of follow, have not only retail but other market makers joining the party. If a company is that good, why is only one person buying shares? That's what you got to tell yourself. Like if your best friend told you this restaurant's the best in the world and you go in and there's no one sitting in there, I would have to assume it's probably not. But if your friend tells you this is the best restaurant in the world and there's no reservations for the next 7 weeks, I'd have to agree that this is probably a very good restaurant. So a bit of basic thinking and common sense is so critical to trading. It really is. Okay. So with that being said, we've done our basic course on options, our basic course on how we integrate prints. We have also, I've created a roadmap of how you place options or prints into a strategy. So it's going to be a template. And what we're going to do, instead of doing classes on options, because I've always believed that the more classes that are given to people, the less likely they are to learn. We need to know the nuts and bolts quick and then base our further lessons on case studies. So basically, actual examples. So the next case studies could be let's talk about OKLO, let's talk about IONQ, let's talk about DJT, let's talk about SMCI, let's talk about NVIDIA. Because practical and practice is how you improve. Theory is great, but at the end of the day, it's about putting theory into practice. And that's where you'll improve and understand. So with that being said, I'm just going to quickly pass it on. Does anybody have any questions for me? Feel free. Millen, you can mute him off. Okay.
Just a quick question on platform. You said you use that to pull the prints. Is that something that we have access to as well?
Well, you need your own brokerage account. At the end of the day, this is trading, so you're going to need to sign up with. We use TradeStation. It's a Fort Lauderdale-based brokerage. Opening an account. Now, as day traders, it does work a little bit different because when we do it, we have to put 25,000 minimum into a brokerage account and maintain that and get day trading approval. So that way we can get access to the actual real-time platform that we can trade off. And that's how we see the prints. To be completely honest with you, and I'm going to make a call to TradeStation later to see if it was an account that needed to be opened from someone who didn't want to day trade, but who wanted to get access to all the prints and use it for options trading. I'm not quite sure how that works, but we will find that out today. But if you're, I know some people don't use TradeStation, they might be using Stock Trade or TD Trade or whatever company or brokerage you're using. Give them a call and say, I need access to see time and sales or prints. How do I accomplish that? Because once you can do that and you can set up a single screen or two computers and you're able to see all the prints coming, so the buying and selling coming in and out of a particular stock, you'll be able to then monitor a stock that you like and wait for those prints to come. Or anytime we're day trading, day in, day out, if there's a stock that's actively moving with the right variables of volume, we will be seeing all this buying and selling, and we put it into the chat and put it into the Discord anyway. So it's always going to be a lot that you can follow just from everything that the group will put out there. So for instance, MBIS, I saw some seriously good buying yesterday. I've seen more buying today, and I'm not seeing, and this isn't one person buying. There is a lot of people buying in MBIS. I can just tell that by the way that it's all buying and printing. So just contact them, Gabe. But I will call TradeStation today and get some more information on that as well for you.
Thanks, Doug.
Absolutely, absolutely. Anybody else? Please feel free to ask me anything you want.
Hey Doug,
Hey,
on
Trevor.
your options contracts, uh, why are you only looking for a maximum of $2.50 per contract?
Yeah, good question. So one of the things that starts to happen is the more you pay for a contract, Trevor, the more that your risk increases, correct? So
Correct.
one of the things we want to take absolute advantage of is the fact that we trade off prints. That gives you such an advantage. So if you find yourself starting to pay $4, $5, $6, $7, $8, I can guarantee you two things. You're far too close to being in the money, or you're trying to buy too close to time. I found that the sweet spot is always pay no more than 250 because we don't care about being out the money. And you don't want to get stuck having a huge risk position because remember, you're paying 250. So for instance, let's say your net gain on the price target was $5 and you paid 450 for a contract. Did that make any sense for your position?
No, risk to reward wise, no.
No, it doesn't. And here's what I found also is if you look at all these trades that we've done, they usually move past our targets or close to it. Some of these trades will move as close to your price target and come right back. But if you pay 250 for it, you'll still have a really good return. So this is not based on me guessing. This is on 7.5 years. I started off at $2 in 3 months, and I found, and this is a really interesting stat, and this is a true stat, that nearly 50% of my trades for 3 years were 2 to 3 weeks away from hitting strike or breaking strike. And why was that? Why do you think I've changed to 250 in 4 months? What's one thing that we saw a lot less of this year, Trevor, and last year?
Follow through,
Yep, but why do we see less follow through? What is the petrol or the gases they say here?
low volume or no vol lack
Yeah,
of volume, yeah.
exactly. So if there's less volume, then it's going to take longer, isn't it?
Yes,
So
got it.
that's why I make all these adaptations based upon. Now, remember, all of my trades, I have them written down. I know my percentages, I know my returns, I know how long it took. And as you guys will see, I've built out a nice template for this. I've got more ideas to make it even better. And what we're going to end up doing is we're going to be, once we create the program for this, we'll be on a weekly basis coming in like this, speaking on a stock, putting up our templates, filling it in together with the buying, with the targets, understanding, and then there's a 7 point strategy of some information that we need to gather. Why do we need to gather information even when there's prints? You might be asking, right? That Doug, why do we need information? Why do we care about the company? Why do we care about C-suite? So C-suite basically means the corporate level. Who's the main people in charge, the CEO, the CFO, the CMO, the COO, they're all called C-suite. You want to know your leadership. You want to know what industry in very basic stuff. You want to know its competition. And why is that? Because in a micro environment, as day traders, Trevor, there's very little that's going to change what can happen in the next 30 minutes, correct? And I mean external
Correct.
factors. But
Yeah.
let's just say today, Trev, you saw all this buying in Nvidia. And then, no, I'm sorry. Let's just say you saw a lot of huge buying in AMD at $140. And you're like, oh, this definitely is going to 160. And you put a position, you're like, you know what? I think this is more midterm. I'm seeing this type of midterm. I know the stock, I know its movement. I can see a lot of accumulation. So you're like, okay, I'm gonna set my contract for 6 months out. And then 2 months after, Nvidia releases a new chip to compete against what AMD had put out. Who do you think suffers, Nvidia or AMD, if that happens?
AMD.
Do you think anybody would buy? Let's be realistic. Who's the number one company right now in microchips? It's Nvidia. They're coming out with all the big stuff. So that will affect it. So knowing what's going on in the macro environment in its basic understanding will keep you in the loop of external factors that could change the sentiment of your stock. And that's going to be introduced in the template that's been created. So what we're going to end up doing on a weekly basis is we're going to be talking about new stocks with new buying. We're going to be inputting in some information of research. We're going to be creating the play. We're going to be doing a lot of that together as a group on anyone who signs up to be part of our options team. Make sense?
Perfect. Thank you, Doug.
Absolutely. Anyone else? Feel free to ask your questions.
I have one, Doug. On the longer term prints, when are you looking for entry on those when the volume comes back in? I guess, after
Exactly.
all the major volume.
Perfect answer, Kevin. But guess
And
what? But let me tell you something else, Kevin. And this is where, remember, I'm just teaching you on the methods that we use options. But if you saw like really large, continuous daily, weekly buying in a company that was entering a space that was about to be on the forefront with great leadership, huge possibilities. Let's just say the CEO and his team already had and scaled two companies in the stock market, and that stock was currently trading at $5. Does it make sense for you to go 2 years out in options straight away? Or is it cheap enough for you to say, you know, I'm gonna buy 1,000 shares. There's no way this buying doesn't get me to 50 over 2 years. That's
no,
a
yeah, I agree. The shares will be more feasible at 5.
yeah. And then let me ask you something else. You're now in this position and you keep seeing it's continually building like Palantir, but now it breaks on earnings. And let's just say for 6 quarters, the earnings would say, yes, we're improving. We got new contracts, but we're still minus 68 cent loss the next quarter, minus 50 cent loss the next quarter, minus 30 cent loss the next quarter. So revenue's been growing up, contracts have been coming in, but they're still at a loss. And someone's been building, when I say someone, I mean a bunch of people have been building massive positions through all of those losses getting less, but the revenue's increasing and the contracts are coming in. And then one quarter comes along, Kevin, and now they're profitable. The revenue went up, the contracts came in, contracts are now larger, longer term, and now we're no longer negative 7 cent loss or negative 60 cent loss. We are now positive 23 cents. Do you think the volume starts moving it to higher price points at that point?
Yes, for sure.
So can you take contracts now?
Yes, I think so. My secondary question to that was, say you see huge prints, say one day and the volume does fall off, would you be willing to take a put position as well in the medium term?
Nope.
No, you
No.
only one way.
I say the way I would look at that, Kevin, is if I'm in a 90% trade, why am I giving any exposure to the 10%?
Gotcha.
Always go with everyone else because the only thing I could say to you is you can hedge your bets, But if you're trying to play everything up and down, you would dilute your attention, you would dilute your profits, because every time that you take that position, it comes at a cost, Kevin.
Yes.
So you could pay 250 for a short-term put, and it just went for a quick pullback. You lost your 250, but here's the reality. What is your new cost for your long position now?
Yeah, you got to add that 250 on.
Exactly. So now if you had a net profit of $6, but you had 250 of your original cost for the long, then you decided, hey, I'm gonna take a quick put. It never worked out, and you took 250 there. Now you made $1
Yeah.
instead of 350. So always go with the strongest sentiment. And you know what that also is? It's trying to overachieve on a position is actually called greed.
Yes.
So let's not do that. Let's stick to what we know. And what I would say to you, instead of that, double up. Instead of paying 250 both ways, pay $5 long if it's a high percentage trade, correct?
Yes.
That's my always my opinion on that. Anyone else?
I have one more. If you do on there,
100%.
when entering at 250, do you set a stop loss at all there? Is there a certain number that you're looking, if it breaks, you're getting out, or do you base that upon the prints and the volume
Okay.
that's happening?
So I would say I'm definitely more of a gunslinger when it comes to that. I will hold mine to the end until a complete loss. But I would say for everybody, and that's a great question, Kevin, by the way. I would say for everybody, hold it for at least a 50 cents. 50%, I'm sorry. At least hold it for 50%. So if it gets down to about that 125, 130 is all you can sell it for, I agree. Take it off then. But do not go in and say, well, if it goes down 10%, I'm out. It's a stock and it's moving intraday, weeks, months, is going to fluctuate. And let me tell you something else. If you can read prints and you see it pulling back because it wants to buy more, do you really want to sell or do you really want to add?
No, yeah, you'd want to add to the position.
There you go. You see the advantage that we have in prints? It's everything.
Oh, yes.
It's absolutely everything. All of you who've been here since the beginning that we started market making strategies, I've given DJT, SMCI, IONQ, OKLO. How have we done on those four, Kevin?
All 4 for 4 and $20 moves, I think, in each one of them almost.
So DJT, I paid $1.85 for well out of the strike, $2.25 for where I wanted to be. I sold 70% of the position for $18.75. And that was within about 21 days. Would you be happy
Wow.
with
Oh, yes, that's amazing returns.
IONQ? IONQ right now is up for me. When it was at 37, I had paid for IONQ 275 just because there was no 250 available. And then I paid longer term out there $1.15. When it hit 37, I was at 775.
Hmm.
I think
Yes.
those are good enough returns for most people, right?
Oh, yeah, for sure.
Exactly. So just follow the prints, follow the protocol. Don't get greedy. Be diligent in your understanding. Always make sure you are following the prints of the stock that you're in. Do not just simply rely upon the room. This is your trading. This is your business. This is your hard-earned money. Put the time and focus in, and it will pay you back diligently and significantly. So thanks for that one, Kevin. That was a good question. Anyone else have any questions? Feel free to ask me for yourself. I have no problem with that. If there's something you want to ask specifically for your own form, I'd be more than happy to try and answer that for you as well. No? Okay, with that being said, that was our little intro to how we do options. Next Tuesday, we are going to start with our first case study that might be which will be, in fact, going over one of those positions with prints through a template and exactly how long it took, what were the factors that we considered, and then we're going to put in there the 7-point research of the company as well and create a complete understanding of start to finish of how a trade went. So that is what the Tuesdays will be. Now, that's only going to occur, just to let you guys know, a month, maybe 2 months before it becomes its own program itself. But stay tuned because it's still going to be around for at least a month or two. So appreciate everybody coming in. Hope you guys got some information out of this. If you have any questions, please feel free. You can send them in to Milan. He'll get them over to me. I'll respond back to you. I could even answer that in tomorrow's Trade Exchange. You guys have a lovely afternoon and let's look forward to some more trading. Thank you very much.
Take care, Doug.
Take care.